you've ever wondered, are there any types of mortgages that put you in more in danger for a short sale than other mortgages? Well, this is the right place for you to be. Hi, my name is Don Thornton. I'm a real estate investor. I'm a short sale specialist. In fact, I'm known as Don the short sale guy because I've been focusing mostly on short sales for the last 20 years. I've helped well over 3,500 homeowners in my career to get out from under foreclosure, out from under upside down or underwater property where the mortgage is more than what the property is worth, and to greatly limit the damage to their credit and avoid bankruptcy or foreclosure auction. In this video, I'm going to talk to you about which mortgages are the ones that are going to put you in danger of having to do a short sale. I'm going to talk about 100% financing options like VA and USDA. I'll talk about one of the most popular mortgages for people, especially people getting their first homes, FHA mortgages, and finally the trap that people can fall into if they decide to use their equity to get HELOCs, home equity loans, or second mortgages. So in this, let's talk about the 100% financing options here. Okay, so obviously Veterans Administration, the VA loans are 100%. But what a lot of people don't know is that USDA, the United States Department of Agriculture, also has 100% financing available. In fact, my assistant, who worked with me for 16 years, I suppose, she bought her first house by having a USDA home, and it's not that far from Tampa, Florida. So people think that, well, okay, you can only get a USDA loan if you're out in the boondocks somewhere. But no, actually, there's lots of areas very close to major metropolitan areas where you can get a USDA loan, and again, it's 100% financing. So for people who want to buy a property, especially first time, or obviously if you're a veteran, and thank you for your service, if you want to get in a property with not having to put any down payment into the transaction, well, these are great options. But what happens if things go wrong? What happens if you buy a property and then you're having issues, your job hours are cut, or if you lost your job, you're laid off? What if you get sick, right? What if you get divorced? What if there's a death in the family? What then? Here's the thing that people don't understand is that from a interest paying point of view, when you get, let's say, a 30-year fixed rate mortgage, which is what USDA and VA are, uh, you're paying mostly interest on the first 15 years of your mortgage. So realistically speaking, if you get an interest only mortgage and you get a 30-year fixed rate mortgage, there's not much difference in what is being paid on the interest and what's being paid on the principal. It's negligible. Your first 5 years is mostly interest. It's mostly interest until you're like 10 to 15 years. So if you, let's say you're in the property for 4 or 5 years, and then financial difficulties happen, unless you've had some major appreciation, which we've had in the last 3 years, but there's a market correction going on now. You can't count on appreciation to get you out of that upside down hole. So you're not going to be. Don't think that you're chipping away your principal. You're not. Okay, is what I'm trying to say. So if anything happens to you in your life that limits your income, that is going to keep you from making a mortgage payment and slipping into foreclosure. Well, these mortgages are the worst things you can have. They're great to get you into a house with not much money down, but there's a huge risk because if you stop making payments, you can't sell it unless you do a short sale. So what I'd like for you to do, if you like this content, what I'm giving you, then by all means subscribe to my channel. I do these once a week, and click the bell that'll show you. You'll get notified as soon as I drop a new video. So if you're interested in this topic, short sales, foreclosures, credit, things like that, then you should come here and make sure you consume my content. The second category of mortgages that can lead you to short sales, being upside down, is FHA. Now, what is FHA? It's Federal Housing Administration. It's done through the Department of Housing and Urban Development, and they don't give you 100% financing. They give you almost 100%. They give you 97% financing, and shoot, they even have 90% FHA mortgages, which are also very risky from the point of view of possible short sales if you run into problems. So again, just like with USDA and VA, a lot of first-time home buyers will use FHA as an option to get into a property. And for a lot of people, it's a great decision. I am by no means telling you you should not get these mortgages, by the way. All I'm saying is that the less money you put down, then the more apt you are to be upside down when you sell your property. So what I want you to realize is I covered the interest and the principle in the previous section of this video. Now I want to talk to you about the fact that even if you are, let's say that you owe $190,000 and the property's worth, maybe you can sell it for like say 200. Okay, so you would think, okay, well, good, I'm good. I have $10,000 worth of equity there. But you got to consider the other costs involved in the transaction. You've got commissions, you've got closing costs. What we like to do is just basically say that you need to add 8% to cover commissions and closing costs when you're trying to figure out how much money you're going to be able to take or have in your pocket when the property closes. Okay, so if you sell the property at 200,000 and your mortgage is 190,000, you're going to be upside down. Even though you think you have equity, you're going to be upside down. Okay, so that's the danger with mortgages like FHA because you don't have enough of a spread between what you owe and what you can pay for when you include any taxes, any closing costs, or any commissions. Okay, so leave a comment. Go down and leave a comment. Let me know what you think. Disagree with me, agree with me. If you have any suggestions about what you would like for me to do a video about, by all means, leave one. I love to engage with my viewers. Okay, so I want to talk now about another category of mortgages that can really put you at risk for a short sale, and they are home equity loans, which we call HELOCs, and second mortgages. So the HELOC or home equity loan is such a temptress. It's a seductress that says, "Hey, you've got all this equity. Just get a HELOC and you don't have to use it, but it's there and you can draw upon it whenever you want. It's like your own private bank." And people get drawn into that. And listen, any financial instrument is fine as long as you know the risks, and most importantly, as long as you have the discipline to not get yourself in trouble. And I found that in my 20-year career, that when the market is booming, when the real estate market is appreciating, and everybody and their brother wants to be a real estate investor, or they want to put money into crypto, they want to whatever the latest thing is to make quick money, then the easiest way for them to draw cash to invest is by using the equity in their home. And so and the worst thing that can happen, and unfortunately it happens a lot, and it's happening now here in Florida anyway, is that people will get a home equity loan or a second mortgage, because they're both a second mortgage really. They get the financing at the height of the boom, at the height of the market, and so what you're doing then is you're leveraging your house to its very limits. But what happens if there's a market correction? What happens if it goes down 15,000, 20,000, 30,000, right? Then you've got your HELOC up here, you've got what it's worth now, and guess what? You are upside down. And that's what people don't realize until it's too late. People assume that things are going to be fine, that the market's never going to correct. They're going to keep, they're going to have their job. They're not going to get laid off. The corporation is not going to get merged or bought out by somebody else, and then the new company comes in and gets rid of the people from the company that they took over. Even just the hours being cut. What again? Like, what if you get sick? I mean, who knew that COVID was coming, right? And it disrupted everything. You just don't know what's going to happen in the future. So assuming that everything is going to be fine, it's risky. And that's what a lot of people, I saw that in 2007, 8, 9, 10, 11, 12, when we had the Great Recession. I saw that. I was here before that happened. People forget that back in the early 2000s, the market was hot. It wasn't maybe quite as hot as this one, but it was pretty hot. Okay. And I saw the same dysfunctional thinking that happened then that got people into trouble. It's happening again now. We're just not feeling the consequences on a widespread basis yet, but I really believe it's going to happen. And I believe that in 2023, we're going to see more and more short sales because what I'm describing here is one of the is going to be a huge reason why that's going to happen, by why people are going to be upside down their mortgages for these three categories. So go down to the description of this video. There are some links. If you are a homeowner and you're facing this kind of difficulty, click the link and reach out to me, and I can discuss, how I can help you out of your situation. If you're a real estate investor, if you're a real estate agent, and you come upon these types of houses and you don't want to fool with them, then you reach out to me. Go to the website, and I can tell you how we can do the heavy lifting for you. We can joint venture and do a short sale for you. So I want to thank you again for watching this video, and I'll see you next week.